The easiest way to tell how a company is doing, I'm going to break it down for you right here. And before I get into it, I do want to clarify that this video is not financial advice. This is for your financial education and entertainment. I am a financial advisor, though, as you probably know, and host of a brilliant and budding free financial community at jeremybr.com. So, how can you tell how a company is doing? Well, you can read tea leaves or you can just ask the company. Here's where a company will tell you how they're doing. They're 10K. They're 10K. I'm going to dive into GameStop because this is another video in a series titled GameStop is not a meme stock. But you can look these up for any company out there. This one in particular, I have read for at least 10 hours. Lots of juicy stuff in here. We're not going to get into all of it. And you might be thinking, hey, 10 hours, that's not really very much. If you're a financial advisor, shouldn't you have been reading this for 20 hours? Well, I will just say that 10 hours of reading a company 10K is probably more than your financial advisor has done cumulatively in the past 12 months, okay? Most financial advisors are just glorified salespeople and they don't even like to think about how their money's being invested. Okay, but I digress. A 10K. A couple things that I want to highlight here in GameStop's 10K in particular. So they start off with, hey, just a general feel, kind of an abstract of their business and where it's at. And a couple things to highlight here. One is their store count. So as of February 2025, they are down to 3,203 stores, and they break it down US, Canada, Australia, and Europe. In their sales, they break it down into three categories, basically consoles, video games, and accessories. There's their store count by state. And now they're going to talk about their business strategy. Here's what GameStop has been doing for years. They have been communicating a very clear strategy, which is omni-channel retail excellence, aka online and in person and blended, right? Very user friendly, any way to reach the end consumer. We want to reach that consumer. Profitability. So, as a core business, as a core company, within their retail business, achieving retail profitability, and then expanding from there into new segments, tangential related business lines that could expand their revenue base as a company. Okay, so then they're going to go into a bunch of risks, like every 10K does. I'm not skipping through this. You can read through it if you want. Another interesting point that they put in all of their 10Ks is, hey, we have had and probably will have some short squeezes, as well as other things out of our control. So they are acknowledging we are highly shorted and it continues to bring pain to all of our haters. So just so you know, some more exciting things to come. Sudden increases in demand for our shares, okay? But we're not here to talk about short squeezes. We are here to talk about the fundamental business, the core business, the retail business, the legacy business of GameStop from their 10K. Okay, so if you want to talk to me about a company, please don't send me a link to a news article that's some type of speculative thought. Please send me the page from their 10K that you're referring to. Okay, this is the bread and butter, the foundation, what we can build off of as it relates to our perspective on a company. You cannot just look at a financial news article and think that that is giving you an accurate portrayal of what's happening at the company. You cannot just listen to a financial TV show and think that's giving you an accurate perspective of what's happening in any particular company or certainly the economy as a whole. You want to start with the 10K and then you can add in some flavor from there. You can add in some color from there. But financial news, it is almost always paid for So there is someone on the other side of the trade. There is someone that is interested in that news article being published to hopefully influence your decision making. It is hardly ever an independent journalism, someone giving a thought about a company. It is almost always someone that's being paid to either inflate or put out a hit piece for or against a company because someone else is on the other side of that trade. So, for what it's worth, if you ever see articles out there talking about how GameStop is a meme stock or all these horrible, terrible things, all you need to know is, one, I didn't see that on the 10K. And two, wow, I guess there are still people shorting this company. There are big institutional players who are funding this propaganda. And why would they do that unless they were still on the other side of this trade? So I want you to take comfort, any company you're investing in. If you see a ton of hate mail out there, it's usually a good sign that you're going to have some volatility, but that the upside is huge, that the bets are still on both sides of the aisle related to that company. So back into the 10K. GameStop properties, their retail leases. So they're down to 3,200 leases. They were at 6,000 5 years ago. So they are down to almost half. And get this, guys, they have not chosen to buy out their leases. They've chosen to just roll their leases and allow expirations to inform how many leases they might close. So instead of saying, hey, this store that's unprofitable, whose lease is up in 2 years, instead of saying, let's just buy out the lease right now and close it right now, they're saying, you know what, let's just let it ride. We'll deal with that when it gets here because we have unprofitable stores that are due for expiration this year. And so every year they've been closing stores almost organically. It still costs money to close a store. That's why they wouldn't do it all immediately. It's because in the short run, you're going to pay more to shut down a business than you would to just eat the loss of a business. But you can't eat losses forever, right? So a lot of times, a company, if they're needing to downsize, is stuck because they don't have the cash, they don't have the earnings to afford to close down operations. So the only way they can make it is if somehow they can turn their existing footprint as is into a profitable business. And often that's too tall of a task. But with GameStop, they have enough money in the bank and they have enough earnings just from that money in the bank to where they've been able to downsize profitably. And get this, look at how many stores, how many leases are expiring in 2025. You've got 1,688 stores due for expiration this year. Look at 4 or 5 years from now. In 2028, you have 127 stores. These are stores that Ryan Cohen, the current CEO, has chosen to renew. Right? The year before that, 2027, those are stores that probably were renewed in 2022. 356 the year before that, those are probably stores that were renewed in, or sorry, this is 29, 28, and 27. So probably stores that were renewed in 24, 23, and 22. Why is this important? Well, one, you'll see that every year they are renewing even fewer stores. So in 20, sorry, in 2020, let's say in 2021, the year of the squeeze, where Ryan Cohen was the CEO, it looks like maybe they renewed 771 leases that year. But also, so much was going on with their company and their core business was struggling. And hopefully, you're understanding why I'm bringing that up because they didn't have the affordability to close that many stores. So they had to renew a decent number of them just to stay in business. But each year that's gone on, the core business has performed better. And the new business, which I'll just call the hedge fund business or the M&A business, aka the cash in the bank, has been growing substantially every year, which is hugely supporting their earnings in their cash. In other words, it's allowing them to much more rapidly get to the store footprint that they want to get to. Does that make sense? So every year that's gone on, 27, 28, 29, in terms of leases expiring, these are leases that were renewed in 22, 23, and 24, hypothetically. And look at this. You go from 771, the year of the squeeze, renewed, 356 the next year, 261 the next year. So 356, that's less than half the number before of stores renewed. 261, another 30% reduction. And then 127, another 50% reduction. So they were already closing stores back in 2021. However many leases were up for renewal, I don't know, but it was, I could look it up, but it was a number bigger than 771. That actually would be interesting to look up. The leases up for renewal in 2021, and they only renewed 771 of them. And yet every year they're renewing a smaller and smaller fraction. This year they have 1,600 stores up for renewal. That is crazy. They are downsizing intentionally and they're downsizing profitably, and it's putting them in position to be able to, one, shore up their downside risk because their cost of doing business is going down and down and down every year. But also, it's shifting more and more of their buyers to e-commerce, which is far more profitable generally and far more scalable. And they're becoming much more uh, efficient in the utilization of their assets. So let's keep going. But they're closing a ton of stores and they have a ton available to close. They could be half the size. They could be half the size. And by the way, I don't know if I already skipped it. Oh no, here we go. Store count by country. Okay, so this is important because as you'll read in here, fiscal 23, they used to have stores in Ireland, Switzerland, and Austria that they got rid of in 23. In 24, they got rid of Germany and Italy. And in 25, they will get rid of France and Canada. Well, guess what? All of Canada is. That's 200 stores. In Europe, the only country they operate in Europe is France. Oh, this is 20. Okay, here you go. 193 stores in Canada, 311 stores in France that will be off the books this year. And then of that 1,600, how many of those are already represented by Canada and France? And how many of those are US stores that they will be able to downsize? They'll surely keep some of them, right? But in the 10K, you'll have here's how they're doing from a big picture perspective. But let's scroll down to the full financial statements. Woo! Balance sheet. February 2025. You've got 4.7 billion in cash, and since then they have raised at a 0% interest another 1.5 billion dollars. So epic. Okay, so how's the business doing? It's doing pretty good. We don't have to get into this balance sheet too much because everyone knows they have all this cash, right? No one really likes to talk about it, but what they like to do is downplay it and say, "Oh, cool, you got this cash. So I guess maybe the company's not going to go bankrupt since you don't have any debt." Look at this, long-term debt, $6 million of long-term debt at like a 1% interest. So you have no long-term debt and you have 6 billion in cash and your cost of operations is less than 1 billion a year. So yeah, I don't think you're going to go out of business, but the feather in the cap, right, to the short seller, to the hater is, but your core business is trash. Everyone knows that GameStop, the store, GameStop fundamentally is trash. Well, as I've been talking about with these leases, right, rolling closures year by year, and combined with their cash growing year over year, so their ability to do that profitably and in an expedited way is increasing year by year. So you're going to see way more closures this year than last year. You saw way more closures last year than the year before that. You saw way more closures the year before that and the year before that, right? And yet they have stores that are profitable. So let's dive into it. Overall, on the whole, their operations, right? You've got some billions in sales, you've got SG&A, and oh, here's the feather in the cap. Operating loss of $26 million. Oh, don't worry, we're going to dive into it. I don't like seeing that either, okay? So let me just say that. But I'll dive into it. But then you've got interest income, right? All those billions in cash earned them $163 million. So their income, their net income as a company, here you go, after taxes, $131 million. Compare that to the year before. The year before was $6 million of net income on 5.2 billion in sales. In 2024, 3.8 billion in sales for dramatically more income, right? In 2022, you had almost 6 billion in sales and they ate a $300 million loss in 2022. So from a profitability perspective, what, from 22 to 23, they improved by $320 million. And then from 23 to 24, they improved by another $125 million. What do you think the improvement's going to be from 24 to 25? Well, I'll tell you what, it's already going to be at least a pretty big chunk, if nothing else, than from their balance sheet because they have more cash now than they did last year by almost 2x. But I don't want to talk about the balance sheet. I want to talk about the core business. So here's what I want to do. I'm going to search in this document for their segment information. And let's see if I can get to the chart that I'm curious to see. There's their segmenting their sales by their type. Okay, here we go. Segmenting by region. Here's the big number right here, boys and gals. United States operating profit of $33.9 million. Let's go! Let's go! So, is GameStop a profitable business? Well, in 2024, they were. You saw their net income. Okay, you saw it, $140 million or whatever it was, $131 million. But is GameStop the retailer a profitable business? Well, in 2024, they were. They were in the United States. And what did we just read at the beginning of this document? They are selling Canada and they are selling France. So that's a $10 million drag and a $38 million drag on operational income that they're closing. So let's just back that out, right? So overall as a company, they were 26 million in the red. They are closing 48 million of red. So even if they didn't improve at all, They didn't grow at all. They didn't get any new customers. They didn't get any more efficient. They didn't close any of the unprofitable US stores because some of the US stores didn't make a profit. And let's say all those leases that are expiring, they don't get any better from any of that. As a company, you just cut out Canada and France like they're doing this year, and they are already operationally profitable. They're operationally profitable. And you know what? They're probably going to back out Australia too in 26. And you know what? Their US numbers, they're going to be greater in 25 than they were in 26 or in 24 because of multiple factors. The primary, the easiest of which being their ability to close potentially up to 1,600 stores, and another one being a uniquely difficult 2024 for video games and a uniquely strong 2025 for video games. Let's, out of curiosity, let's check this out from the last year. So this is the fiscal year ending February 1st, 2024. So it's January to January or February to January, I guess you could say, 24 ending in 2025. This is basically the calendar year of 2024. They're profitable in the US, $33 million. Yes, GameStop, the retailer. This is not any interest income. This is not any cash on their books. Let's check it out for 2023. Look at that. $2.3 million loss. $2.3 million loss in the United States in 23. Let's check it out in 22. $286 million loss. So just in the United States, they improved by 284 million, 22 to 23. And then another 35 million, 23 to 24. Oh, oh, failing? Failing? You mean improving every year, increasing operating income and increasing interest income for an even more increasing company-wide net income. So you look at that and tell me it's a meme stock, okay? Just try to say it with a straight face. You can't do it. You can't do it. So those are a couple highlights from the 10K. I want to, in a video soon, I want to model this out and say, okay, so from a PE basis, a price to earnings basis, how would you value this company, the retailer? And I don't want to project out the future. I don't want to try to get speculative on what specific opportunities they're going to get into, but they will get into opportunities. They already told you they will. They already told you they're going to expand their total addressable market. Okay, they're not just going to die on the GameStop, GameCube floppy disk. Okay, they are not going to die on a specific piece of merchandise. They are expanding their total addressable market. But let's not value any of that expansion. Let's just look at the core business as is, which is a profitable business and a profitable operation. Let's look at that business and value it. Say, okay, but what's it worth really? And we'll look at that from a price to earnings basis. So in a different video, we looked at their book value, their price to book, and how would you value their book? And we discovered that the floor of their valuation is probably where they are right now. Can't imagine them being any lower than they are right now from a fair value perspective. And in reality, their fair value from where they are right now is probably actually multiple times the market cap of where they are right now. If they were at 40, 45 a share, I mean, that might be getting closer to a fair value, and that's already a double, right? So we'll look at the earnings from this operation and consider from that perspective what this company might be worth. But don't let anyone trick you into thinking this is a dying company. This is a growing company that is actually shrinking from a square footage perspective, but it is growing from an operational profit perspective. And very soon it will grow from a revenue perspective. But right now they're intentionally resizing. They're going from 6,000 stores down to how many do you think they might want? 1,000? Maybe 1,000, maybe. So they've got another 2,000 stores probably that they'll close over the next 3 years. Whoo! I wonder what those profits are going to look like then. I wonder what the profits are going to look like then. And by the way, their profits are even better than what we talked about, not only because we can hone in the US and back out the international divisions that they're closing, not only because we know that the growth rate in the US is on a trajectory and they will perform even better this year than next year as they close more unwanted stores. Not only because the revenue is in position to do really well in 2025 from a video game industry perspective, but also because their costs of doing business have been inflated by the cost of closing their unwanted stores. So even that 37 million or whatever it was profit in the US. So we just talked about those three reasons why their profitability is really bigger than it looks. But the biggest reason is because their expenses are largely tied up in closing their unwanted stores. Are they going to have to close a store that's already closed next year? No, it's a one-time expense, right? So when you're looking at a company, very common that you would back out one-time expenses and back out one-time earnings. Anything, if whatever, a corporate executive bought a lottery ticket in GameStop's name and GameStop won $100 million, no one would value that from an earnings perspective because you can't do it again. Similarly with expenses, when you have expenses that are one time in nature, you don't really value that in the company because they're not going to happen again. Now, GameStop, they will have more closure expenses for another couple years, but the meat of it is last year and this year, and they're not going to close 1,000 stores per year forever, right? Even if they wanted zero stores. Well, guess what? They're already halfway there. And they have more operational profit to support it than ever and more interest income to support it than ever. So how long do you think it's going to take them to get to zero stores if they want to get to zero and be a totally e-commerce platform, which, by the way, we know they don't want to do. Why? Is it because of a financial news article I read? No, it's because of their 10K. They told you they want to be an omni-channel retailer. So they want to have some stores. So it's not going to go to zero. So how many more years do you think you're going to have inflated expenses tied to store closures? And what do you think their profitability is going to look like on the other side of those one-time expenses? That's the name of the game. That is the question to answer. But I hope that at the very least from this 10K, you can see, man, this company doesn't seem like they're about to like go bankrupt. Doesn't seem like they're about to like, cease to exist. Sure seems like their numbers are looking pretty good. And like, they might be looking like even better, even better than they could be looking. This ain't no rocket science, right? Right, guys? Okay, if you learned something in this video, give me a like or a subscribe or a sub, subscription, whatever. Comment below your questions. I'll talk to y'all soon.